Hi everyone, and welcome to Payments on Account workshop. Okay, so we'll be talking about payments on account and also how to get an estimate of your tax bill for payments on account or for any other reason. Okay, so first of all, what are payments on account? So some people might already be familiar with them. I say a payment on account is when HMRC asks you to pay a payment on account, ironically, a payment on account for the next again tax year. So let's say, obviously, we're in at the time of recording, we're in July, but let's say when you're filing your tax return for, so we're July 23. So let's say you're filing your tax return for 22, 23. If your tax bill is over a certain amount, HMRC could also say that by the 31st of January, not only have you to pay your tax bill for 22, 23, but you also have to prepare a proportion of your tax bill for 23, 24. I had to think there. So basically it's an advance of the following tax year. And it kicks in when your tax bill for any given tax year is over £1,000. Equally, if your tax bill, if you have a rough year and your tax bill essentially goes over under £1,000, then the payments on account will stop and so on and so forth. So that's kind of what they are and when they kick in, but we'll go into this in a little bit more detail. So how many payments on account are there? There are two. Each payment is the equivalent of 50% of the estimated tax for the following year, and these are paid 6 months apart. The first one is paid on the 31st of January, and the second one is paid on the 31st of July. So this is another reason why I encourage everyone to do their tax return as soon as they possibly can. Now, I know like it's in the way, I know things happen, but definitely don't leave it till January. Because if you have had a really, really good year, you file your tax return in January, you realize you've not only got to go frantically looking for the tax bill for the tax return you're just filing, but you're also paying 50% towards next year. And that frightens a lot of people, as you might imagine. So therefore, we want to be prepared. This whole point of the Financial Resilience Hub is trying to prepare, estimate, look ahead, think ahead, be, take whatever precautions, I suppose, for want of a better word, you can to make sure that you know exactly what you're essentially looking at. So yeah, so 31st of January and the 31st of July. So there'll be some people, for example, we're filming this workshop in July. And there'll be some people that'll have to do a payment on account for the end of this month. In fact, I know a few of our clients do. Okay, so does that mean, so if you pay a payment on account, the one in January, the first one on the 31st of January, by the 31st of January, the second one by the 31st of July, does that mean you won't have to pay any more? Maybe, maybe not, but not always. So on the 31st of January, when you pay your first payment account, 31st of July is when you pay your second payment on account. And then the following 31st of January, which is essentially the deadline date for filing your tax return for the year that you have paid the payments on account. If at that point your tax you've done had another really good year, even better than the year before, you will have to make up the difference. So essentially, so we'll go through an example in a minute in terms of what happens if you have to reduce them, but essentially it'd be the same what happens if you have to increase them. So yeah, first payment on account on the 31st of January, essentially before the tax return has finished. Then you've got another payment on account on the 31st of July, which will be just after your the tax year is finished. And then by the 31st of January the following year, which is essentially the deadline for for filing that tax returns, then that is when you pay any difference. Equally, if you have paid too much, you can either ask to get some of that money back, or you can use it to make the payments towards the next payment on account. So obviously, first time it happens, why are HMRC making you pay more tax? Which is the common response. They don't, as they hopefully have explained, that payment on account is a payment on account is a payment in advance essentially, and that's what it is really. when every sole trader I have come across, when they hit that pivotal moment that they have to pay the payment on account, it's like, oh my God, why am I having to pay more, kind of thing. And it's literally just the moving from paying in arrears in terms of, paying your tax return for the year that's well gone. You're simply moving that to paying in advance. And that's what you're moving from. You're moving from paying in arrears to paying in advance. And yeah, it stings a little bit, but it is worth it. Um, um, and the reason they ask you to do that, well, obviously it helps their cash flow, let's be honest. But it helps your cash flow too. Honest to God, it does. Now, okay, yes, and that first time it's a nightmare for a lot of people, unless you're being totally on it. You've either got an accountant or what you're essentially your tax bill is looking for, or you've been putting money aside every month or even every week for your tax bill. It's to help you kind of spread the cost of your tax return rather than you kind of frantically looking for the tax year that has well gone. It's helping you to kind of plan in advance and spread the cost of your tax return over the course of the year. And I know it can be very stressful the first time, but it does help to reduce the stress. And I know many people, once they're in the system, once they're paying the payments on account twice a year and then paying any difference, on the 31st of January, it helps them feel a little bit better. They know it's all paid, they know it's all great, and it really does. It does help them sleep better at night, knowing everything's covered. And yeah, okay, admittedly, it's not helpful at first, but as I say, it can help to spread the cost. And it's especially well suited for any business that has a steady stream of revenue. Especially obviously if that business is growing, but equally, if you're a fairly stagnant business and you're just plowing along, maybe have the odd peaks and troughs, but nonetheless fairly consistent, then it really is quite useful. However, what happens if you have some serious peaks and troughs? Then obviously, yeah, that's when you might have a really fantastic year one year. HMRC assume that you're going to have another fantastic year. Everybody, even you, maybe even assume you're going to have another fantastic year. But then something happens for whatever reason, and you have a really crap year. If that's the case, you can ask to reduce your payments on account. Now, as I said earlier on, if your tax bill itself goes under £1,000, then the payments on account stop, but then they will kick back in when you go back over. Alternatively, what I would suggest is you ask to reduce your payments on account, and at least then you're always kind of paying something. Okay, and you can reduce your payments on account. On the workshop, I'm going to be showing some people how to do that. Anyone that wants help with that, go into breakout rooms and stuff. However, if you're watching the recording, if you go into the course module, you will see there's instructions on how to do that. They were correct at the time of writing it last year. They should all be okay. I did one actually just a couple of week or so ago with somebody. But yeah, give me a shout if the instructions aren't correct. But they should be, and just in case of following it through. Alternatively, you could phone up HMRC, but that can be just as hard sometimes. Okay. But before you reduce your payments on account, it's really, really important that you estimate what your tax bill is going to be. Because when you need to make that request, you do have to be fairly honest about it. You can't just take a stab in the dark and go, oh, I reckon it's going to be half, because and the reason and this isn't to frighten you, but basically if you falsely ask HMRC to reduce your payments on account and it turns out you had another similar year or more, there is word on the street, so to speak, that they can charge you penalties for that, because essentially you underpaid your tax when you were due to it, and therefore you're paying your tax later. Even although they're only payments on account, essentially HMRC just don't like being lied to, which is natural. So yeah, don't ever reduce your payments on account without at least doing your forecast. And at that time, you're being honest about it, essentially. And if things change, then things change, but always be as honest as you possibly can. Now, okay, so to do your tax return, now depending on where you live within the UK, tax rate varies slightly, but we're just going to take an average, okay? We're just going to take a very simple approach here, and it will cover, give or take, maybe, I don't know, 50 quid either way. It should be fairly accurate, okay? And we say we don't have to be totally spot on. We just want to get something. We want to get a ballpark figure, okay? So we're going to go through an example, but essentially what you're doing is you're going to work out what you're going to predict what your total sales are. Then you're going to deduct your estimated costs, allowable costs. Then we'll take off the personal allowance, and then we multiply that by 20% on average for tax and 9% on average for national insurance. And this is good for anybody, that even people that haven't got to the payments on account stage. It just helps you understand roughly how your tax is calculated, if you haven't already worked it out by now. And allows you to then essentially budget going forward, essentially, or even every month you could sit and do this rough calculation, and you'd be total pro by the end of the year. Okay, so obviously, yeah, okay, so Ross estimates that his sales will be about 10% less than last year, and last year's were 30,000. Okay, so 10% less of that will be 3,000 less, so 27,000. However, as he's a freelancer, his costs will be roughly the same, and they're coming in about £5,000. So as said, a 10% reduction in sales from 30,000 takes him to an estimated sales of 27,000. Less his 5,000 costs. Okay, we get 22,000, which is essentially what his taxable profits are. Then, like everybody, he's allowed his personal allowance, which is 12,570. So we take 12,570 away from 12,000, and we'll get 9,430. Okay. These slides are, so just to say, these slides are in the course, so you'll hopefully have seen them by the time you if you're watching the recording. So you'll have time to read over the slide at your own pace and help you understand where all these figures are coming from. Anyway, so 9,430 taxable income, and his estimated income tax of 20%, which works out at 1,886. So that's 9,430 at 20% comes to 1,886, and that's how we work out his tax. This is how we would work out your tax as well. Okay. Then we have to forecast his national insurance. Okay. So going back to going back to the 27,000 sales less 5,000 costs, we get 22,000 taxable profits. So his taxable profit, I say, is 22,000. And then we have to work out, we have to apply the main self-employed NI, which is calculated at 9% after we deduct the NI threshold. And for simplicity, it is actually, in fact, it is actually 12,570, which is exactly the same as the personal allowance. It didn't always used to be this, but it is for this year and possibly will be going forward. Okay. So 22,000 less 12,500 is, as we had in the previous example, 9,430. We then apply the class 4N percent, which is 9% of that, which comes to 849. So 9% of 9,430 is £849. So we go back. So we've got 1,886, which is his tax, and 849, which is his national insurance. And that's how much he reckons his total tax bill is going to be. Okay, which if we just jump to this second paragraph, first of all, so what we've estimated is the two of those together comes to 2,735. Okay. But Ross paid, so when Ross filed his tax return, he was due to pay £3,604, and therefore HMRC would have asked him to pay 50% of that, on which would be 1,802. That would have been his first payment on account on 31st of January, and another £1,802 on or by the 31st of July. But in July, Ross has estimated that he's only going to be his total tax bill, he estimates is going to be 2,730, not the same as last year, which was 3,604. Therefore, if he wants to reduce his payment on account, he will be able to. Okay. So if we work out what he's already paid to date and what he's due to pay, we work out that he's due to, we estimate him to be due to pay 2,735. He's already paid 1,802, which was his first payment on account. Therefore, he is left to pay £933 on the 31st of July, as opposed to the 1,805. So as the HMRC are going to be looking for another 1,802, but he's going to ask for a reduction and tell HMRC he will only pay 933, which is the difference he's left to pay, due to a 5% downturn in sales. Now, that's all he has to say, though there's a little box where if you do it online, there is a little box that says, I can't remember the exact wording, but it's long lines of why are you asking to reduce this payment on account? And he doesn't have to write War and Peace or anything like that. He just has to simply say, you know, he is expecting a 10% downturn in sales. End of. He doesn't have to go into elaborate details or anything like that, okay? If, however, it was like the complete opposite and it was a 90%, it was like, 90% downturn in sales, then yes, he might want to elaborate a tiny little bit more than that. But, they don't want to hear too much information. They just want to know, they just want you to give them confidence that you've worked, that you have calculated what you're due to pay fairly confidently rather than just taking a stab at it, okay? So how do you reduce them? So as we're going to do a few breakout sessions later, but you can reduce your payments on account at the time of submitting your tax return. You can either ask your accountant, if you have an accountant, then you can ask your accountant to make the request when submitting the tax return. Or if you do your own tax return, which I'm sure most of the people in the hub do, then look for the question near the end. That's at the time of submitting your tax return, okay? But if you've already submitted your tax return and you're now sitting in the year when the payments on account are due, you can just log on to your government gateway account and you'll see on the right hand side about payments on account. Once you go into the sort of payment area, and you can apply to reduce them. As I say, the instructions are on in the module. Okay, just see the course module for more details. But we're gonna just move on to anyone that's live today into the breakout rooms and see if anybody needs help with this. And for anyone that's really struggling, just to let you know, basically more than anything, just to remind you that you get a 50% discount on any help directly with your tax return or calculating your payments on account. Okay, so just give it a go, try and see if you can do it yourself. But if you get stuck, just please give us a shout. We're here to help you. Okay. So thanks for watching. And now we'll go over to, oh no, yeah. So yeah, thanks for watching. Now we're just going to go over to any questions with people live today on the workshop. If you're watching the recording, then please ask them in the forum or come along to the monthly Q&A session, first Friday of the month at 2:30 to 4:30, and ask any questions then. Okay, and hope to see you soon. Okay, take care.